Welcome back. Today I'll speak about, give you a quarterly update again, and I do this once a quarter just to give you an update on what I see happening in the region, and potentially, where I also see opportunities and kind of where my focus has been over the past few months. You've seen that on the Substack, but I thought I should summarize it here as well in a short presentation. Remember, none of this discussion should be taken as investment advice, purely for informational and educational purposes. And if you do want to invest in the region, I suggest you speak to a financial advisor who can give you some personalized financial advice. So this is the index here. You see that the market has really gone nowhere ex-Japan, and China has had some weakness in Chinese equities, Hong Kong equities. But really, the outperformer in Asia has been in Japan, and the Nikkei 225 is basically trading back at 1989 levels, more or less. An extreme bull market, and we're kind of at the other side of what we were back in 2011, when the yen was strong and Japanese equities were extremely cheap. Nobody wants to look at them. We've kind of gone full circle now, and the yen is extremely weak now. And that's benefited the stock market because Japan is an export nation, and earnings have therefore gone up quite a bit because of that. There's also been some structural trends, but this it does feel like a bull market for sure in Japan, and for someone who's cautious like me, I'm certainly quite becoming a little bit nervous perhaps. But anyway, that's enough about markets. Today I want to speak about 4 of the trends that I'm seeing, and one is the absolute bust that we've seen in Hong Kong equities. The second theme is about the new president in the Philippines, and also the investment boom that I think might be forthcoming in the country, and then also talk about corporate governance in Korea and what's known as the Korean discount in terms of valuations, Korea versus other countries. So is Hong Kong over? That's been a great discussion on Twitter, and I think also it reflects investor sentiment, and I want to point to this article in the Financial Times early this week, written by Stephen Roach. He used to be at Morgan Stanley. Now I think he's a professor at Yale. He says, it pains me to say that Hong Kong is over, and that's quite a statement. I mean, a city doesn't necessarily die that quickly. Some exceptions like Calcutta, but it takes many decades, and I don't think that it is at all justified to say that the city is over. Although it will of course change and become like a typical Chinese city over time. Of course, used to be known as the Pearl of the Orient, and just look at the beauty. You realize that Hong Kong is really. It cannot really be replaced. It's a major financial center. It's the place where Chinese companies go to raise overseas capital because of the advantages it has with the Hong Kong dollar, which is freely convertible and also pegged to the US dollar. And there's a great degree of talent as well in Hong Kong, helping with these types of capital raising efforts. And that's why it also continues to be a major center for asset management and wealth management. I also want to, you see in this picture here that it's a very dense city. And I remember, from working in the industry, that you could have 6 or 7 meetings in a single day in Hong Kong and get a lot done during a short trip. Whereas that's not the case in Beijing. That's not the case in Manila or Jakarta, where you could have 2 meetings and travel hours between each. It just is a city of efficiency, a city that never sleeps. And I think it does have something special. This is a double bottom for the Hang Seng. Doesn't mean anything necessarily. Doesn't mean they will bottom. But I'm just saying that now we're back to 2022 levels, when actually economic fundamentals were very weak. This was before the zero COVID policy was lifted, and before we saw a recovery in the service industry and transport industry. Also for Hong Kong. Hang Seng has some Chinese companies, so I don't want to draw any conclusions from this necessarily, but certainly stocks are very inexpensive, that's for sure. What sparked the decline from 2017, I guess, in the Hang Seng was, I think, for Hong Kong domestic shares was the anti-government protest. There's been protests since 2014, but 2019 they really blew up, or they became massive in terms of hundreds of thousands, even millions of people on the streets protesting this national security law that was proposed in spring of 2019. And COVID came 2020, tourism stopped completely, and it kind of killed the Hong Kong economy for a few years. But that's pretty much recovered now. Retail sales shot up when the borders opened up in January 2023. And there's been, we're now back to 2016 levels, but not 2018. And I think perhaps it will never come back completely because there used to be a lot of smuggling from Hong Kong, parallel imports or Taigo. And that trade is basically over because the border controls have been tightened up significantly in the past few years to China. But you could see a healthy retail sales, healthy economy as well. This is another chart that really surprised me when doing this research. I took the data from David Webb's website called website.com, and he in turn gets his data from Hong Kong airport arrivals versus departures. And I then took the cumulative number here. You saw it, which meant that there was a net migration up until mid-2023. And actually, there's now net immigration, which means that Hong Kong's population is actually growing again. Whether that's due to mainland Chinese or immigration from other countries, I'm not sure. But I'm also seeing people moving to Hong Kong, which seems to suggest that the city is probably not dead just yet. And this is tourism to Hong Kong. You see the bottom here. That was basically 2022. So back in October 2022, there was no tourism to Hong Kong. Now it's back to 70% of the pre-COVID levels. And perhaps it'll never come back completely, but certainly the trend is pretty positive over the past year. And life insurance premiums sold to mainland Chinese visitors, I think that's partly is now at an all-time high. Should be positive for companies like AIA and Prudential, but we're not really. Of course, they could also be driven by capital flight from China. But anyway, it's another data point that suggests a recovery. And I also want to make the case that the Hong Kong legal system is fairly strong, in terms of order and security, and also the justice system seems to be independent so far, although that could change. Finally, on the Hong Kong tax system, it is extremely attractive, and I think the people they don't quite realize exactly how attractive it is. There is no alternative to Hong Kong in terms of the tax system. It's the most attractive tax system probably anywhere, except for some maybe Middle Eastern countries. Highest marginal income tax 17%, capital gains tax 0, wealth tax 0, GST 0, import duty is mostly 0. The stamp duty is 15%. It might go down to 0 by in the next budget. In Singapore, though, you have to pay 60% as a foreigner, and you also have to pay GST. So while taxes are low in Singapore, they're not quite as low as in Hong Kong. And also in many cantons in Switzerland, you have to pay wealth tax, and that's not the case in Hong Kong. So if you're a wealthy mainland Chinese, or if you're a wealthy Russian, why not live in Hong Kong? It's a spectacular city, really. Interest rates are the real challenge for Hong Kong. It has a paid currency, which means it imports monetary policy from the United States. And as far as I can see, inflation pressures have really come off quite a bit. And if you believe that, I think there's some visibility as well in the inflation rate for the US, and it's probably going to come down by mid-year. And once we get that, below 2% level, perhaps by June or so, you'll see rate cuts, and that will be the real positive sign for Hong Kong equities, for the Hong Kong economy, I think, especially the property market. You see here property prices are falling right now, and they've been falling for a while. It's due to the mortgage rates. There's just no affordability; is just quite weak, and also see that in the luxury segment. But also the stamp duty. I think the stamp duty was introduced 2010, if I'm not mistaken, and another one 2013. I forget the exact dates, but we've had stamp duties since 2010, and that led to actually transaction volumes being very weak for quite some time. And now there's talk about reducing the stamp duty to zero for both locals and foreigners. And that could lead to revival, I think, in the transactions volumes, which would obviously benefit agents, it would benefit the developers as well. The economy seems to be doing quite well, continuing to revive in the fourth quarter. Inbound tourism, private consumption is quite strong. And the guidance is that visitor arrivals should increase further, and interest rates might be cut at some point in 2024. I also want to point to another interesting development that I included this chart on Monday in my email, and it's about interbank liquidity in China, showing that there's been a recent spike there, suggesting that in fact you do see some signs of a potential for greater lending in China. Of course, assuming a certain reserve ratio, you will see that actually being lent out, or rather being used as reserves for loans. Whether that has something to do with the TSF print, total social financing for January, I'm not sure, but it was quite strong, 9.5% year on year. Was actually not too bad. Could have implications for the currency perhaps, but for equities, you would think that this is bullish. There could be some seasonality issues, of course, and also January tends to be the month when new quotas are you have new quotas, and banks are keen to lend in the first month because of these new quotas. They use a window guidance in China to lend. And as I said before, the valuation multiples are extremely low here. You see that the price book is basically back to October 2022 levels. Also back to 2019 levels, 2009 levels, GFC levels. So Hong Kong stocks are extremely cheap. And you can see here, this is the broad index. I've always thought that the Hang Seng index was expensive in terms of the valuation multiples. But even Hang Seng starts to look quite inexpensive in terms of multiples for companies like Alibaba and Meituan and so on. So let's move on to the next topic, and this is about the Philippines. I think that this is an interesting theme because it's contrarian, and it kind of things happening quietly and with people not really paying attention, except for some individuals on a Smart Karma. But let's talk about Philippines. Bongbong Marcos, who was elected in, I think, 2022, and he is the son of former dictator Ferdinand Marcos, who ran the Philippines from 1965 to 1986. And his wife, or Bongbong's mother, Imelda, is here on the right-hand side. She's still alive in her 90s. So what does Bongbong Marcos mean for the markets? Well, I think it's too early to tell, but the market has been stronger in the past 6 months. And this marks, but it's still below what it was 10 years ago. The market has been trading flat for an extended period of time. And this is despite actually quite decent earnings growth. Philippines has decent companies in terms of return on equity. And you should see some compounding in the market. But for some reason, it's been consolidating for a long period of time. And this data is a little bit dated, but certainly the base rate is about over 6% now. And this has been weighing on the economy. We came out of COVID with strong retail sales, but this is weighing on the economy, especially property sales. And I think that once you see declines in the interest rates, that will not only be positive for the economy, but also cause loss aversion, I think, in individuals who had, who have received 6% yield and suddenly see a much lower yield of let's say 3%, 2%. If that happens, of course, that will lead to moving into equities, I think, or buying property. GDP numbers a bit soft here, and CPI has come down a lot. And there's talk, at the Banco Central, this talk of, I'm misspelling here, but this talk of fear of inflation expectations being anchored and such, I don't think that's the issue at all. The issue is that the US dollar is so strong. The BSP, they don't want the currency to weaken too much against the US dollar, and I think that's why they keep the interest rate at the current level. So it all depends on US monetary policy, really. And meanwhile, foreign ownership levels are now about 20%. They used to be 30% at the peak in 2014. I mean, a huge shift in the interest in Philippine equities. And it really, I think during COVID, people sold the last shares. And there's just really nobody paying attention anymore, except for perhaps Smart Karma, like I mentioned before. The P ratio about 12 times. It might be lower actually if you look forward further. But 12 times compares to about 16 times historically. It's always been a market with quite a high valuation multiple, a little bit like India. But certainly these days that is not the case. So it's not Pakistan level of P ratio, but it's also I think a more conventional and perhaps safer market too. So let's talk about the election then, and BBM as he's known, Bongbong Marcos, and he's in his 60s. Well, the family came back in 1991, and they were allowed back into the Philippines, and the family, several of his family members are now legislators, and he himself was a senator from 2010 to 2016. But he doesn't seem to have a lot of vision. He has the family name, and but during the election he didn't participate in any of the debates, and he also didn't provide any kind of guidance of what he was going to do, even in his first address to the people. And I think that's just remarkable. So what does he actually stand for? And he managed to maneuver this through a social media campaign, which was proved really effective. And majority of the voters, they're now below 40. They don't remember what it was like during Marcos. Basically, human rights abuses, repression, and martial law. Frankly, that was one of the issues that Marcos basically brought the country back to stagnation from being quite a wealthy country, in the 1950s and 60s, comparatively speaking, in Asia. And he teaming up with Duterte, Rodrigo Duterte's daughter, Sara Duterte. She is the vice president, but there's now a rift between the two, and he basically used her, I think, to gain popular support, and they're now at odds with each other. There's talk of secession of Mindanao in the south, and there's a fight going on with Duterte family being very close to China and Marcos being very close to the United States, and I think that also has an impact on the current feud between the two. Anyway, so what are Marcos's reforms? And on the surface, it looks like we could be seeing an investment boom. And I've been talking about this before. I'm not sure whether it's actually going to happen, but there's been a lot of talk about public-private partnership. There are government agencies working on this, figure out formats that are going to get private capital to invest in infrastructure projects. Something that's sorely needed. Anyone who's been to Manila knows that how hard it is to get from point A to point B. But yeah, so that's in the works. There's been a huge number of infrastructure projects that have been approved. Also, Duterte, he signed a law that scrapped the foreign ownership limits in sensitive sectors such as telecoms, airlines, shipping, and railways. The president still has veto power over specific projects, so that lessens the national security risk. But it also, with foreign companies being able to invest more in the Philippines, you should see greater capital formation and credit growth, which is then positive for stocks, obviously. I think also Philippines is moving closer to the US geopolitically, and that's been a surprise to many, including myself. The Philippines and Singapore are the two only countries in ASEAN who are not publicly supporting China's Community of Shared Future program, and which is basically a way to spread their influence in the region. This strongly suggests that they are on the side of Japan, Korea, United States in this ongoing conflict that we're seeing across the world. And I think that means potentially lower risk of capital controls. I hypothesize that could be the case. And if we do see a war breaking out, perhaps your money will be safer actually in the Philippines than, with a country that's closer to China. Let's say, China itself, or I don't know, maybe Vietnam. So there's also taxes on junk food, like I mentioned, infrastructure projects. He also started a sovereign wealth fund, which opens up the scope for corruption, of course. It's odd why a country that doesn't have a budget surplus, it doesn't have much savings, why it would need a sovereign wealth fund. It sounds almost like it's designed for corruption. But let's see. So what we saw during Ferdinand Marcos, Bongbong's father, we saw that there was enormous corruption, and on the right hand side here you see Imelda Marcos's shoe collection of 3,000 pairs of shoes. It's just a sign of enormous amount of corruption, and somewhere between $5 and $10 billion dollars were stolen. Some of it has been recovered, but not all of it. They're just very greedy individuals, to be honest. And I would imagine that perhaps now we're going to see the same, an infrastructure investment boom, and greater centralization of power, and history repeats, perhaps. And we've seen some signs here. I mentioned this before, that Bongbong Marcos's cousin, he has a company called RYM Business Management. Is he a nominee shareholder? Most likely. And they've been buying stakes in companies with valuable licenses, also injected capital into the Philippine Veterans Bank, and also set up a JV with ABS-CBN to provide accurate news, which sounds a lot like censorship to me. So I'm not sure exactly how far he will go. I think there was a lot of fear among the investor community that he would follow his father's footsteps, but perhaps he will, and that's not necessarily negative for stocks in the short run. Perhaps we'll see a new cycle of capital formation. This is from the book The Great Money Illusion by Mark Faber, and in this book he mentions that in the 70s the country was glamorous and booming, and houses in Forbes Park cost more than similar properties in Beverly Hills. This is a residential area in Manila, and yeah, so it was boom times at that time. And my point is that when you see this, when you see capital formation, that comes hand in hand with credit growth, and some of that money ends up in bank accounts that will then be spent in casinos or on the stock market. Greater liquidity tends to increase wealth inequality, and that's frankly positive for stocks, potentially. I also think that the reforms that we're seeing now in the Philippine Stock Exchange are also very positive. Full disclosure, I am personally a shareholder of the Philippine Stock Exchange, partly because of these reasons. I'm seeing so many things happening that could be positive for the exchange, for the market. One thing is that Gcash, the financial super app, has developed a single stock trading feature, and they are going to IPO, I think, later this year, potentially 2025, sorry. And if the IPO is pushed in the app, it will cost some of these 80 million users to start trading using the app. So it will be very seamless experience of setting up an account and starting to trade. And this is really the last part for the Philippine market. It's been an institutional market for so many years, but now potentially we could see a closing the gap in terms of retail participation with Vietnam and Malaysia. Also, other things, short selling was introduced last year, revised odd lot sizes, basically reducing the investment minimums, and also a potential drop in the transaction tax from 60 bips to about 10. And if that happens, that would be extremely positive, I think, for transaction volumes and the PSE, as well as dividend taxes. So derivatives being offered from 2025, including index futures. So, I mean, so many things are happening here that are positive, and this is happening quietly. And I think also you're seeing that stock are starting to move up in the Philippines, and they're still remaining very inexpensive despite all these developments. So let's move on to the last topic then of today is about Korea. They've always traded at a low level, and for anyone who's tried to go activist in Korea, you all know that how difficult it is to get anything done when it comes to changing or influencing company management teams to do the right thing. But anyway, so Korean shares, they continue to trade at a discount, huge discount to Japan and to Taiwan. And this is for good reason. This is due to this discount is due to corporate governance. Korean companies tend to hoard cash, and you also see that here. This chart is a little bit dated, but nothing has happened really. The payout ratios continue to be extremely low, 15% here according to these numbers, lower than Japan, which is typically seen as a basket case in terms of capital allocation. And so Taiwan is much higher here on this. I think maybe that's gone up even further now these days, but they're just not paying out dividends. And the reason is, families, they see the listed companies as their own, and they don't see minority shareholders as equals. And indeed, they're not, because they don't have as much influence. They don't have, as much say in the management of the business, obviously. So Prime Minister Yoon Suk-yeol, he has vowed to lower the discount. And this comes hand in hand with these efforts of getting developed nation status in international organizations. And that will lead to greater capital inflows as well. But to get there, you need to have perhaps greater access for foreign brokers into Korea. And we're now seeing a liberalization of the FX market. Prime Minister has also suggested lower capital gains tax, rather increasing the hurdle for capital gains tax, for no capital gains tax, to 5 billion, I think from 1 billion won. And then there was a short selling ban introduced last year. Stocks went up due to that. I don't really see how that's a smart move, but it happened anyway. And then most interestingly, the FSC and Korea Exchange, they've started to look at what Japan is doing in terms of naming and shaming companies that are not performing well in terms of return on equity, and basically ask companies to outline plans on what they should do to improve their valuations. And this is there's a survey now with companies and investors to figure out whether this could actually this is worth pursuing. But if it happens, you could see I think some improvement on the margin with greater buybacks, which are almost non-existent so far, and perhaps better capital allocation. We'll see. I mean, there's the determination there, and I think also governments tend to get inspired by countries around them. This quote I think is interesting. Is from James Smith from Palliser, who has who is waging a campaign against Samsung C&T. He says, "We feel strongly that the Japanese president is driving incremental change in Korea," and if he feels strongly about that, then it's interesting to note that the market itself is actually trading at fairly average multiples, and among the small caps, seeing significant declines since the bull market in 2020, 2021. And some of them have already started responding, starting to see some spikes in some of these share prices. And I think that's another quiet fact that people aren't really speaking about, except for the guys over at Smart Karma, I suppose. So to conclude here, I think Hong Kong shares are the most beaten down anywhere in Asia. This is really the market where you will find stocks that that trade at PE 8 and 8% dividend yield higher than the P ratio. Typically a sign that the shares are pretty beaten down. I'm talking about small caps here. And then the Hong Kong economy, I think, is doing just fine. And it's not affected as much as China is by this decline in residential construction, property construction. And then the problem is high interest rates. And Hong Kong is the market in Asia that's most geared to US interest rates, geared to interest rate cuts. So if there are cuts, Hong Kong would be the economy that benefits the most. And then in the Philippines, he's been more hands-off, more business-friendly than expected. He's been moving towards the US in terms of geopolitics. And there's also been a huge number of infrastructure projects being approved. And we haven't really seen much from that yet. But if his father is a good president, then perhaps we'll see an investment boom, just like we saw in the 70s. And there's also so many reforms being undertaken, with regards to getting more retail investors into the market in the Philippines. And corporate governance in Korea is obviously awful. Everybody knows that. And I think the prime minister he's determined to raise valuations for Korean companies, that raise the price book. And it's now copying Japan's approach of naming and shaming. And I think that's a really interesting theme. And another catalyst would be access by foreign brokers. Interactive Brokers is supposed to offer access to Korea at some point. We still haven't seen any developments there. But I mean, that could be another catalyst. Inflows from Western investors who haven't been able to invest in Korea before. So that's it. Thank you so much for listening. And if you have any questions, just go to my website, asiancentrystocks.com. Sign up to the email list, and you can also ask me questions anytime. And thank you so much for listening, and I'll speak to you next time. Bye.